Welcome to PhillipCapital Experts Talk. My name is Osama Bakhtiar and I'm from Philippe Securities Research. Today we are privileged to have Mr. Philippe Berthelot, Head of Credit Management Team and Portfolio Manager from Natixis Asset Management, to share with us his macro views on the European fixed income market and investment strategy. An industry veteran with more than 20 years of experience, Philippe had stayed at CDC Gestion as a fixed income and money market portfolio manager in 1992. He joined Natixis Asset Management in 2010 after 12 years with AXA Investment Managers. He holds a master's in management science from the European Business School and a master's in finance from ESC Tours, a French graduate business school. He is also a CFA charter holder. Thank you, Philippe, for taking that time to talk with us today. Please share with us a brief outlook on the European fixed income market.
European fixed income markets do witness low inflation and a low growth regime. What is contrasting with the previous years is this year Euroland will benefit from the combination of a dropping euro currency and a dropping oil price, which in combination makes a stronger growth for Euroland. We should near around 1 to 1.5% this year, which is extraordinary in European standards. That said, the big news for us has been the announcement at the end of January by the ECB about gigantic quantitative easing.
In view of the easy monetary policy in Europe, in Switzerland, Germany, Denmark, and several other European countries, government bonds are trading at almost negative nominal yields. Could you explain the negative yield conundrum and how it affects your investment strategy?
It seems paradoxical that the price for risk, the price for time, is negative. It sounds totally paradoxical. Where does it come from? You have 1/3 of sovereign bonds in Euroland posting negative yields, as you stated. It comes from the fact that you have a scarcity of high-quality bonds with high ratings and the combination of the ECB action. The 1.1 trillion QE is huge. It's an ocean of liquidity. We all know what 100 Singapore dollar means, or 100 euro, but 1.1 trillion euros is extremely huge. It is approximately twice as much as net issuances from the government bonds for the whole Euroland. It's huge. It means that you have a huge buyer of bonds and no marginal seller. And this is why it explains you have a pressure on prices to go up, and with the inverse relationship with yields going down and down and down, and it's perfectly understandable or foreseeable that a 10-year bond yield, which currently trades around 33 basis points, 0.33%, may be negative by the end of June this year.
What should we expect when the QE program by ECB starts to roll out?
The announcement has been done on the 22nd of January and will be implemented the 5th of March. We think, and it's going to be huge at the market impact, as I said earlier on, 1.1 trillion until September 16 means 60 billion purchase every month of ABS, covered bond, and more importantly, sovereign bonds. But there are not a lot of huge sellers. It means more pressure on prices to go up, yields will go down, and investors are starving for yieldy investments. They are looking for extending the opportunity set. A typical government bond investor will look further the rating spectrum, will buy investment grade credit, investment grade investor will buy high yield assets, high yield investors would buy convertible bonds, because everybody is forced to get more juicy assets everywhere. If they can go down the capital structure, if they can lower the average quality rating of their investment portfolio, they will do that. This is the major impact for fixed income market in general and for the whole risky asset classes in general. For the next 12 months, every asset class would perform accordingly thanks to the ECB action. It's not that good because it doesn't discriminate between the good, the bad and the ugly, because in a notion of liquidity, every asset class will perform, even toxic asset classes.
Any particular themes, strategy, or opportunities in the fixed income market which investors can ride onto?
With that ocean of liquidity provided by the ECB, you should benefit from positive performance wherever you go in the rating spectrum. We think that currently single B high yield investment is deserving a lot of attention. You have a lot of opportunity there. Investment in the cable and the media in high yield is also very interesting. In investment grade financials do exhibit very interesting yields nowadays still, not for long, but still benefit from very interesting yields. And you have some peripheral bonds for people who can invest in Spanish bonds or Italian bonds, where you still have some juice there. Again, not for long, but still available for the time being.
What are the risks investors should cautious to?
Sovereign risk has not vanished. It's still there in the background. Greece is a perfect example of that. It's not fixed. We need to find solution to lower the burden of a heavy debt to GDP ratio, and it's still there. Peripheral countries like Italy, Spain has begun to implement structural reforms, but Italy, and I would include France, still need to implement reforms. What Draghi, the president of the ECB, is doing is to enable countries to have time to implement structural reforms. He can't do everything on his own. He just enables countries to implement what needs to be done and fixed.
All eyes are on Greece now. So what could be the risk to the stability of the country itself and to the 19-nation currency bloc as well as the rest of the world?
It seems that there's been a bit of complacency. It's true that Greece is just less than 1% of the whole GDP in Euroland. It's not a big country. The debt is bought by public participants, no more in private hands. This is why it hasn't had so many, I would say, major impact on markets and risky asset classes. That said, we know the difficulty of lowering the debt to GDP ratio of 175% currently. Mr. Tsipras, the Prime Minister of Greece, and Mr. Varoufakis, his Finance Minister, need to find solution because it's not sustainable. On the other hand, Greece owes 40 billion to France, owes 60 billion to Germany. In total, they owe 260 billion for public participants, and we need to find a solution. It's not easy. It's going to be tricky. It takes time. It demands time, and this is why they've been able to extend the program by the ECB by 4 months. But in any case, it's not fixed. This is why it's still a trap. Sovereign risk is still there in the background, and we know that we need to think of it every time we do our investment decision.
Do you think the markets are too complacent about risk from Greece and Brexit?
It's true that for the time being, markets have almost ignored what's happening in Greece, because they thought that they could arrive to a conclusion that would be beneficial to risky asset classes. I'm not a specialist of equity, I'm a specialist of fixed income, but on a relative value basis, you could be amazed to see that you've got 1% yield on investment grade, whereas you have 3% dividend yield on the DAX or the CAC 40, which are the German and the French equity markets respectively. That you could say, well, equity markets do exhibit a very interesting or appealing opportunities versus fixed income, but it's much more volatile. This is why it's a balance between two markets, two, I would say, brothers, but fixed income definitely has been favored by regulation, either Basel III for banks or Solvency II from insurers.
2015 is a politics-heavy year in Europe. Following Greece election in January, we would be seeing Britain, Spain, Poland, Denmark, Finland, Portugal, and Estonia going to polls this year. Could you share with us some of your insights on political risk in Europe, particularly for Spain, as there are speculations that Spain could be the next Greece?
It's true that it's a year of election, which means a year of danger. The people are fed up with austerity programs. You still have a lot of unemployment figures in Greece, in Portugal, in Spain, in France, and in Italy. Then you may face a change of governments, which has taken place in Greece. The next wave of danger could be Spain. I was in Madrid 2 weeks ago. People do feel that the economy is much better, but it's not felt across the street. Some people have benefited from that, but not the entire people. And this is why it takes time. It needs time to be sorted out. That said, when you look at the peripheral countries, Spain has made a huge job. When you look at economic growth, it's much better. When you look at public expenditure, it's much better. When you look at current surpluses, it's much better. This country has made huge structural reforms and it's now benefiting the economy. But the people in the street do not feel it yet. And we'll see whether or not populism in Spain will win or not in November. There is a risk, but I'm still optimistic about Europe.
Once again, thank you, Mr. Philippe, for sharing your thoughts with us here today.
Thank you very much.
For more information on unit trust, please log on to www.poems.com.sg/unit trust or talk to us at any Philippe Securities branches. Thank you.